Bitcoin is back below 77K, and I'm confident that I know the reason why. A lot of times in life, the correct answer is the most obvious, and we have to start looking at the Strait of Hormuz and asking ourselves, what risk does this pose to crypto? In today's video, that's exactly what I'm going to tell you. What risk does the Strait of Hormuz being closed pose to crypto prices? What do you need to know as we move into the summer months, and how can we stay prepared? If you want to find out how this connects to crypto, throw me a like down below. Help us get to our goal of 1,000 subs, and let's jump in. So guys, not my favorite video to make, but I have to give you the good news with the bad. Bitcoin back below 77K at the time of recording. We've been falling really for the last few days. So why is this? And I've nailed it down to a few reasons, and they all do stem from the Strait of Hormuz. And I know you might be tired about hearing this, but after this video, you're going to understand exactly how this impacts crypto, and I'm going to give you real-time indicators that you can use at home to keep up with this yourself. So let's dive in. Now, the main effect that Hormuz is having on markets is its impact on liquidity. Have a look at this chart here from 42 Macro. Global liquidity, key driver of asset markets. I'm sure we're all aware of this. You can see a little divergence here, but for the most part, they follow each other around. Now, why do we care about liquidity? Well, because the Strait of Hormuz being closed actually drains liquidity, and it does this through a number of ways. First and foremost, the economies that push liquidity into markets, that push liquidity into the financial system, they need oil to do this. They need to have oil and plastic. They need to be able to do business and do economic activity to bring that liquidity in. Otherwise, they're not able to do so, and it starts to drop down. And as you can see, guys, we even have the S&P down about a percentage point really over the last few days. And again, that's connecting back here, the stock market and Bitcoin and cryptos connected to global liquidity. Now, the US and other economies have been somewhat resilient during this Hormuz situation, but they're not immune to liquidity. I want to show you a clip from Darius. He's going to break down just how liquidity plays in here and the risks that you need to be aware of. Have a listen.
However, the U.S. is not resilient to the global liquidity cycle. The U.S. is the world's largest net international investment deficit economy. If the supply chains remain broken and the Federal Reserve is pivoting its reaction function in a hawkish direction, both of those things are going to cause a drawdown in global liquidity.
So you have supply chains broken, we can't get the liquidity that we need, plus we have central banks pivoting to a hawkish positioning. We have central banks getting ready to hike rates. And even though the Fed is not expected to hike rates, other central banks are. I want to show you, this is a executive summary from Darius as well. Policy tightening priced in over the next 12 months. You have the Swiss National Bank plus 1 hike. England and Japan plus 3 hikes priced in over the next 12 months. Europe, 3 to 4 hikes. And you got the Fed at half a hike. I don't know what half a hike is, but imagine if the Fed moves up to a 1 full hike, 1.5, maybe even 2 hikes priced in over the next 12 months. So it's not that the Fed is actually hiking rates, but just that markets expect them to. Now, this will start to draw down global liquidity. This will start to tighten financial conditions. How else is global liquidity affected? And these are the 3 things that you can keep a look at home. Now, let's break down exactly how these components affect global liquidity. I got this from Michael Howell over at Cross Border Cap. First of all, the price of oil. And you can see here, I mean, this explains a lot of the move lower because you have oil going higher. Oil is now up, almost, $3 or $4 over the last few days. And so for every $10 that oil increases in price, that's a 3% drawdown in global liquidity. So you have a drain in global liquidity happening here from gas moving higher. Now we have the MOVE index. This measures volatility in the bond market, treasury debt, people buying and selling government debt. How volatile is that? Every 10 points higher in the MOVE index is a 4% drag on global liquidity. And you can see that over the last few days, the MOVE index has shot up 10 points. So that's a 4% drain in global liquidity just over the last 5 days. Okay. And these are things you can look at home. You can see these and see, remember back at the beginning of April, look at what we had. At the end of March, beginning of April, we had the MOVE index coming down. What did we have Bitcoin doing? We had Bitcoin going higher. And I'll bet you we'd see the same thing here if we just zoom out on oil. Let's have a look over the last month. Oil, oh, wouldn't you know it? A big drawdown in oil prices in the beginning of April, correlating to a move higher in Bitcoin. So there's a direct correlation here. And then we have the DXY. This is the strength of the dollar. And as the dollar moves higher, global liquidity falls. So for every dollar higher of value in the DXY, so 101, 102, is a 1% drain on global liquidity. And if we look, we've had about, over the last 5 days roughly, we've had about a dollar move higher in global liquidity. So just from these measures alone, we've seen about a 7 to 8% drag in global liquidity. And if we go back to our chart here, global liquidity is a key driver of asset markets. So you know what I mean? It's not rocket science, guys. And this is why I'm fairly confident that we're seeing Bitcoin go lower. And this is what I've been warning you about on this channel. I'm very bullish on structurally what we have going on in the macroverse. And I'm going to get into that why in a second here. But we have to acknowledge the risk that Hormuz plays in this situation. Oil going higher, bond volatility going higher as a result of this, as a result of inflation going higher, and we'll get to that in a second, the DXY moving higher as a result of, Fed tightening. This is bearish for Bitcoin. This is bearish for global liquidity. So that is one of the key reasons. And these are 3 things you can keep an eye out at home. So hopefully you take advantage of that. So also we have inflation moving higher. Now, inflation really, again, this is a result of higher oil prices. We had CPI coming in at almost double the Fed's 2% target. PPI, this is what producers pay, and it tends to lead this other stuff because this is what, this is what the distributors are paying at almost 6%, triple the Fed's 2% target. Core down at 4%. Core excludes food and energy, so it's a little more of a stable read. But again, this is very high. And inflation will spook markets because, again, it starts to do all of this stuff. It starts to impact oil. It starts to impact the MOVE index, starts to drive yield higher, which is something we're seeing. So this is a problem as well. And I want to play a clip from Jordy Visser here. He was responsible for over $1 trillion at Morgan Stanley back in his day. Check out what he says about inflation.
What matters is where is headline inflation relative to what people expected. People did not expect inflation to go higher in the market. You cannot buy stocks at without any risk and believe that if inflation goes higher and rates go higher, that it's not going to have an impact on the market. That's just not true.
And so it's just not true. Inflation will have an impact on markets. Aside from how it makes the Fed and central banks behave, markets just kind of get squirmy when inflation starts to shoot up because, again, they know what comes from that. Central banks react, prices react. It's a whole dynamic chain. There's a lot that goes on behind these moves. And to us, it may seem a big move in Bitcoin, but for these big institutional players, it's just as simple as seeing a number move and they make a corresponding maneuver in their position. So we see big price swings for us, but for them, it's just another day. So this is another thing too. We've got inflation moving higher. And again, this is something that we've been warning about on this channel. And it doesn't make me happy, but I wanted to explain to you guys why we're seeing this move. I promised you a little bit of good news, and this is where I want to get into this because what we're seeing still on a net basis is tailwinds in the macro cycle, meaning it's moving us into a better place. But this Hormuz situation does risk that. Now, there's 6 key macro cycles, as Darius will point out. It's growth and inflation. It's monetary policy, what the central banks are doing. Fiscal policy, what the government is doing. Liquidity, we all know what that is. And then positioning, which is basically how over-positioned are we? Are we very bullish on stocks? Are we buying? Or are we kind of bearish on stocks? We're not really buying. Prices are kind of low versus bullish positioning. Prices are very high. And right now in the S&P and the AI trade, prices are exorbitantly high. And so Darius is going to break down why he's bullish, but then he's also going to tell you why he's concerned about this Hormuz situation and what impacts this could have on markets. This is a little bit of a longer clip, but there's a lot of alpha. Have a listen.
What can make that not go well is if obviously the Strait of Hormuz just stays closed, then we're going to lose the modest tailwind in the liquidity cycle. And that'll obviously cause the meaningful headwind in the inflation cycle to remain a meaningful headwind. We don't expect it to remain a meaningful headwind over the medium term, but it'll stay a meaningful headwind if we're wrong on the Strait of Hormuz dynamic. And then ultimately, if you have the liquidity cycle inflecting to a headwind, inflation cycle staying a meaningful headwind, then you're going to lose the tailwind in the monetary policy cycle. And if you lose the tailwind in the monetary policy cycle and the liquidity cycle and the inflation cycle stays in a meaningful headwind, then you're going to go from neutral in the growth cycle, which is currently, we expect it to go back to a tailwind. You're actually going to go in the wrong direction to a headwind. And so that's how you can start, causing real negative outcomes in financial markets.
So what he's telling you is that the positive effects that we're seeing from growth, we're seeing the economy grow, that's good. We're seeing liquidity improve, that's good. Monetary policy, we were supposed to cut rates. Now we're kind of staying still. That's kind of neutral. Fiscal policy, we're seeing more spending from the government. Inflation was going down. Now it's going back up. This is how we get from a net positive to a net negative. And it's all a result of this Hormuz situation. So I hate to be a big old fat stick in the mud, but that is just the way that it is. And I wanted to make this video and let you know so you're not wondering what on God's green earth is causing prices to go down? I thought we were bullish. I thought the Clarity Act was getting passed. Why are we dipping? This is why we're dipping. Because of the Strait of Hormuz, because of the effects to oil, the MOVE index, the DXY, inflation, all of these things impact asset markets and drive them down. What have I been saying for a while now? Let's pray that the Hormuz situation resolves, that we can get oil flowing, and then we can start to put this behind us. If you appreciated today's video and you appreciate the depth of research, throw me a subscribe down below. Tell your friends, tell your grandma, tell absolutely everybody in your entire family to subscribe to Crypto Rant and like every single one of our videos. And leave a comment. Let me know if you learned anything. Do you think the Hormuz situation gets straightened out soon, or do you think it's not even a concern? In any case, thank you for being here. We'll see you in the next video.